Welcome to Swapskills financial markets videos, showing you what you really need to know. Talking about some of the risk areas to be discussed by bankers when they're covering corporate clients. I want to spend a few minutes talking about their fiscal position. Now, whenever you see the word fiscal, mentally substitute the word tax. Nowadays, banks are very wary of offering tax advice. Even if the advice offered is legal, this is not a popular avenue to pursue and you may end up with a reputation risk. One place to find out about a company's tax position is in the notes to its accounts. The example I've used here is from the American aluminium producer Alcoa from their 2012 accounts. Now, let's say a company has tax loss carryforwards. These are credits which may be offset against future income, though this might just be capital gains and not absolute earnings. Some tax loss carryforwards have no expiry date. Some might have a 10-year expiry or maybe a 20-year expiry. What this means is if you don't use them, you lose them. So what can you do? In some cases, you could consider a sale and leaseback. Now, let's say your headquarters or one of your commercial buildings is on your books for $200 million. Now, the property arm of a commercial investment company like an insurance company or pension fund offers you, let's say, $300 million for the building. Now, this $100 million capital gain between what you bought it for and where you can sell it might be offsettable against the tax loss carryforwards. Well, great, you've just sold your building, so now where do you work? Well, the investor, they don't want to move into your building. You're simply part of their investment portfolio. By owning your building, it helps them diversify the investment portfolio. It might guard against inflation by giving capital growth, and it will also provide them another stream of income. So what they will do is they'll consider leasing the premises back to you with nice tax-deductible lease payments. Maybe you can use the funds to top up the company pension fund or redeploy the money into a high-yielding project. As for hedge accounting rules such as IAS 39 or IFRS 9 or FAS 133, which is a Financial Accounting Standard 133, be careful. The problem you've got is you could ask one of the major accounting firms like Pricewaterhouse or Ernst & Young exactly the same question, but you might get a different answer. So interpretation on accounting is up to the company's own auditors, and banks should hold back from offering advice on perceived hedge accounting treatment. Well, this brings us to the end of our brief podcast. Look at swapskills.com for other topics of interest in financial markets.